Okie dokie. There's Chelsea. There's Raquel. So people hop on. Sure y'all can see me like really well. Can you hear me? I think there's Tracy.
Hey, good evening.
Can you hear me? Okay, great. Good evening. All right. So I just did send out a blast email to everybody, and it looks like we've gotten a couple people that will continue to jump in. Everybody, this is Miss Tracy. And Tracy, I'm going to let you introduce yourself and what you're going to be covering this evening. I'm thinking that everybody, just like us, has seen a lot of changes happening with the market, seen a lot of changes happening with loans, which obviously affect a lot of other things, not just real estate. But I do want Tracy to introduce herself, and then we'll get going.
Excellent. Well, thanks for having me here. I have been buying, so I've been doing it a few years, and we've seen this in the market. We'll talk about that tonight. And during times like this, seller financing really thrives. It's always happening, but it especially happens in these types of markets. So I'm excited for everyone to be here. I started out buying and selling notes for an institutional note buyer. They used insurance funds when I went to work for them in 1988. The gentleman who started that company out in Washington State had already 40 years. So I got to draw on their experience working with them for 10 years. I come from a title and underwriting documentation background and learned the investing side while I was there. And then in 97, started my own company, just a small private investing company. We use a lot of self-directed IRA funds to buy and sell notes for long-term holding. And I've used it to also buy and sell real estate. So just excited to be here and share the knowledge.
By the way, we are also live on Facebook, I believe, so just keep that in mind.
Fun. All right.
Yes, absolutely. All right, Tracy, what do we want to talk about first? I think that for me, being in my industry for 6 years and then having a bunch of friends basically who've been in it longer, the best that I can do is guess, and the best that they can do is go to patterns and repetition of cycles to make, I think, an estimated guess. Where are we at right now? What's going on?
Well, I just strapped in my seatbelt and I'm ready for the wild ride. So right. I lived through the 90s and I lived through the 2008. And I think that we cannot control everything that happens in the market, but we can be prepared and we can control our reactions and our attitude, and we can add tools that tend to work in these kind of markets, because we don't know exactly what will happen, but I feel that we can position ourselves to take advantage of the opportunities.
100%. I agree with you. And by the way, anyone that's listening or watching, I will try to mute myself in a minute and go on Facebook, pull that up. So if there's any comments or questions, then I'll have those prepared for the very end. I just have the interface on Zoom set up. So any questions or comments that you do have as we go along, feel free to put that in the chat. We'll come back to those at the end of whatever we're discussing. I'm excited. Again, if you have any questions, not just about the presentation content, but any questions in general, maybe that aren't covered, or anything that maybe requires a little bit more experience or knowledge, this is the opportunity to ask those questions. And it doesn't just have to be multifamily. Tracy just went over some of the things that she has experience in, and it's not just real estate. So we're here to be a wealth of knowledge and to help us to share resources and be a community. Tracy, go ahead and launch into what we're covering this evening, and I'll monitor for comments or questions.
Excellent. All right. Well, I have a few slides I'd like to share. Would that be okay? I think you have to give me permission. Yeah. And I'll try not to get too slide heavy. I'm just going to pick some of these out and kind of give you a taste for seller financing. Excellent. All right. So I wanted to show and share with you guys a little bit about seller financing. And you might surprise you to know that there's 27 billion with a B dollars of seller finance notes that were created in 2021. I am waiting for the stats to come in for 2022. But there's a lot of different things that we can look at here. Primarily, what is exactly seller financing? Probably a lot of you were wondering just how big is the market and why is it good now? And we can also talk a little bit of why buyers and sellers finance, and then how you might go about selling a note. And I have a couple of strategies I love to use the seller financing, which are partials and wraps. A lot of people like to know, well, what's the ideal note and what kind of team are we going to need to build a team that does seller financing? So of course, I'm not an attorney or a financial advisor. This is just based on my experience. We always recommend that when you're doing deals that you work with those qualified professionals. So exactly what's seller financing? You might have seen these ads, right? To what for sale by owner? Well, it involves people, property, and paperwork, a lot of paperwork, but no less than the traditional lending. So what does a seller financing deal look like? I always love to show this example. I've got Sam, the seller over here, and he's got a house for sale. And if he will elicit for sale for $200,000, then we've got Barb, the buyer, that comes along. And so far, this looks like a normal transaction. She's going to put $40,000 down. She's going to owe $160,000. But instead of getting a bank loan, Sam, the seller, is going to let Barb, the buyer, make payments to him over time. This is seller financing, where the seller owns the property, sells it to a buyer, and lets them make payments to them, and they are the bank. So once that happens, Barb, the buyer, gets her deed. Sam, the seller, becomes the note holder like the bank. He gets a note, and in your state of Texas, he gets a deed of trust. Now, we do see, like this example, 30 years. We see them shorter, but 30 years is pretty average. We do see higher interest rates generally on seller financing. So this example is 9.75%, $1,374.65 per month. Goes through a normal closing. There's still title insurance. And so all the normal things that you see, everybody is still protected. But what I really want to tickle your mind with tonight is how big the market really is. So in 2021, there were 27.3 billion in seller finance transaction, and that was not an anomaly. There was 23 billion in 2020 and 23.9 in 2019 and 25 in 2018. So just in the last 5 years, there's been 123 billion in seller finance notes. Now, we also track all this data by the count, the number of deals, and we'll come back to this chart. But if you look at this, you can see that after the subprime mortgage meltdown, the market kind of stalled in 2008, 9, 10. All the markets did. What happened was the banks stopped lending. And what we see that the seller finance stats increased during that time where banks weren't doing as much lending. And then they sort of leveled off after that. And it was even happening during the good times when people could get 3 and 4% rates. People were still seller financing. And I know a lot of our callers tonight, since you're based in Texas, are from Texas. And seller financing, the #1 producing state for all the years I've been tracking these stats, Texas is the largest producing for seller finance notes. So we don't have to deep dive into this too much, but I'm located out here in Florida. We buy a lot of Texas notes. Florida's #3. My home state of Washington state's usually in the top 10. And all states have some seller financing, but you are at a prime location being in Texas for seller financing. So what's happening in 2023? So that's all great, but what's happening now? Well, we all know interest rates are on the rise. It's harder to get financing, whether it's residential or commercial. We have a lot of inflation, which is the reason interest rates are going up, is trying to curb the inflation. And we have some economic uncertainty, which really hit home last week when we saw some of the bank failures out in California. And so the one thing that's the saving grace right now is unemployment is low. So that piece of the economy seems to be going strong. But we do see in a lot of markets, it's regional, but in certain markets, home sales are slowing down. They're getting back a little on price, not too much, but they are definitely slowing down days on market, not as many over asking, waiving inspections. Some might say we're entering a balanced market. And I hope that's the case for when it comes to real estate. However, some are concerned there is a natural recession and we could see some property values drop. So when all of this happens, when interest rates rise, people have a harder time qualifying for a mortgage. Banks tighten up the credit. And when banks tighten up the credit, it gets reflected on this mortgage credit availability index. So why am I showing you this? Well, this shows how easy it is to get a traditional 30-year bank loan from a bank. And back when things were rocking and rolling in 17, 18, 19, and 2020, the index, it was easy to get a loan. So the higher it is, the easier it is to get a loan. So it was rolling along about 185. When COVID hit, the banks tightened up. And then the real estate market surged. It's kind of surprised us all, but that's what happened. But still, it was a little bit harder to get loans. They tightened up their restrictions. And then we saw it drop again, availability drop again when the interest rates started to rise. That's what you're seeing there in that 2022. So we are seeing about 100, which is the baseline, and it hasn't been that low, that hard to get credit since the 2012, 13 years. And what we saw in those years, when we line these up side by side, that's when we saw an increase in seller financing. So we've had a lot of seller financing the last 5 or 10 years. My prediction is we're going to see more seller financing. That's why it's really important to learn about that, because what we see is buyers sometimes have issues, properties sometimes have issues, and sometimes sellers will consider financing just for an investment strategy. So this might be a good time just kind of to break and just kind of see if you've got any questions. We've got more slides, or how do you want to proceed from here, Kaylee? It's your show.
Yeah, sure. So one question we got was, do you have to own the property outright when seller financing?
That is a great question. So it can go either way. Yeah, it can go either way.
Second part to that would be, is there a such thing as like arbitrage?
Yeah. So I do have an example that we work in here with an arbitrage where the seller still owed money. So it's certainly simplest when the seller sells and they own it free and clear. But most of the transactions I see, probably about 70% of them, the seller still owes money to an underlying. So when they bought the property, Sam, the seller in our example, still owed money to, say, Bank of America. So Sam, the seller, could then wrap that and sell to Barb, the buyer. He collects his payment, then he remits the payment to Bank of America. Now, that's where there's some very good arbitrage opportunities. If Sam, the seller, can go at 9.75, 10%, and he has a loan to Bank of America, one of those legacy loans at the 3 or 4%, then obviously he's making that spread or that arbitrage exactly like you asked. Now, the next thing most people say to me when they hear about that is they say, well, can't the bank call the loan due? And that is true. They can. They have the option to do that. I have seen over the years that as long as payments are current and taxes and insurance are kept current, that banks don't typically call those due. They normally call them due because people miss their payments or the tax and insurance aren't being kept current. So some people say, well, maybe that'll change, because if they've got these low interest rate loans out there, maybe they would call them due because now they could lend it out at higher rates. But the reality is most of these banks sell them off into mortgage-backed securities. The servicers are busy, and as long as the payments come in, they usually don't call them due. But if it did call due, then Sam, the seller, could do two things. He could sell his note and pay off the underlying, or he could give Barb, the buyer, an incentive to go out and finance and pay him off. So there are strategies for doing that. We've got some numbers that we can look at here in some future slides of how that arbitrage might work, but great questions. All right, you want me to keep going? Yeah, all right. I will keep going. So let's just look a little bit more. Why would buyers finance? Well, buyers can avoid costly loan fees. They don't have PMI premiums, which are what happens when you have less than 20% down. They can sometimes get more favorable terms. They have less restrictive underwriting when it comes to the amount of the down payment, their credit score, their proof of income. We see this happens a lot with people that are self-employed or real estate investors that might have great credit and some down payment money, but they might not have the 2 years of W-2s or profit and loss statements that a bank might see. And we also see it when they might be at the top of debt to income ratios that banks have. And we also see investors that have a lot of properties that are financed that banks say, nope, we don't want to do that anymore. So seller financing can be a way for buyers that may be maxed out on their conventional traditional financing to go in and use seller financing as a buyer. So why might sellers finance? Well, they might have a property that has some challenges. Maybe it needs some repairs before a bank would finance it. We see a lot of deals under 100,000. Believe it or not, there's still some properties out there in that price bandwidth the banks don't like to finance. If a seller has a property slow to sell, now that was not the market in the last few years, but as we see days on market to increase here in my Central Florida market, we're starting to see the days on the market increase. So that's a prime time. Sometimes sellers will take an offer for seller financing if they've had the property on the market for 90 or more days. Sometimes
90 or
those
more
sellers,
days.
90 or more days is kind of my litmus test, 90 plus days. Yeah. So if you see days on market over 90 days, sometimes sellers will be a little bit more open to seller financing. If the seller didn't meet bank holding time, so maybe they bought it and they've only owned it a few months and now they're reselling it. Banks don't always like that. And sometimes we just see it distressed. You know, there might be probate, it might be an estate. The seller might need to move out of state. He might be a tired landlord. He's had problems with tenants. All those reasons might be why they might consider seller financing. And then you have some sellers that are just really smart and they get how interest works. And so they say, we'll do seller financing because I want that 9-10% interest secured by real estate. I want to maximize my selling price. I know I'm going to have more buyers interested in my property. And if Sam, the seller, didn't live in that property, then he's got a capital gains problem. If he's, it's a good problem to have, but nonetheless, when you sell property you didn't live in, you don't get that homeowner's exemption to capital gains. So when Sam, the seller, sells his investment property, he's going to have capital gains. And if he sells on an installment sale, which seller financing is an installment sale, there's a section in the IRS code. This is no funny business. It's been around a long time. And he can defer his capital gains over the life of that seller financing and just take back the basis each year and the amount that he's getting in on the seller financing. So you have to talk to an accountant how it works in your situation if you're the seller, but that's one of the reasons some sellers like to use seller financing. And then of course that long-term interest income, and then we can leverage with things like partials and wraps. And we talked a little bit about the wrap arbitrage earlier in the question that came in, but those are the reasons that sellers like to finance. So if we go back to our example, and we remember that Barb the buyer agreed to pay 9.75 for 360 months at 1374.65. Well, that's a lot of interest. If she makes that payment for 30 years at 1374.65, she's going to pay back $494,874. That's over $330,000 in interest. Now, Barb the buyer has the right to pay this off early. Yeah, if she can refinance at a lower interest rate and save herself some money, she definitely will do that. We see most seller finance notes pay off in 7 to 10 years. But if Sam the seller wants to not wait for all that time, he could elect to sell all the payments or some of the payments. So if Sam the seller sold the next 10 years of payments, a note buyer might say, hey, Sam the seller, would you like some cash now? We'll take an assignment of your deed of trust and endorsement to your note. We'll fund you $100,000. We'll collect the next 10 years of payments. And then when the 10 years go by, we'll reassign that deed of trust note back to you. And Barb, your buyer, is still going to owe you $144,925. You're thinking, how did that happen? How did 160 only go down to $144,925? Well, that's all that interest. So basically, Sam the seller was just selling off the interest mostly, a little bit of principal for that amount of time. So this is where myself, a note investor, likes to play. We like to come in and buy some of these payments from sellers that have financed. You might see yourself as Barb the buyer. You might see yourself as Sam the seller. You might see yourself as Tracy, who likes to do note investing. Or you might see it as a wrap. And this is some numbers on a wrap, like the question that came in earlier. So in this case, if Sam the seller still owed the bank, say $151,000, and he had a rate of 4%, then he's just got payments of $763.86. So every month that Barb the buyer sends in $1,374, Sam has to send $763 to the bank, but he's going to net $610.79 per month for those 324 months. Then when that bank loan pays off, then he'll get that full payment of $1,374. So this is one of those wrap situations where you can turn a rental into a cash flowing property without having to be the landlord. I like to say I'd rather be the lien lord than the landlord. There's benefits to both in a portfolio, but notes work really great in self-directed retirement accounts. Buying real estate, selling real estate, being a landlord works really great while you're building your portfolio. So just a couple more slides and we'll take some questions. If you're going to sell the note for resale, the best down payment is 20%, 10% minimum. Credit scores of 680 or higher, although we see a lot of notes we buy with no credit scores or 600 credit scores. A 9 to 10% interest rate, and preferably a 20 to 30-year term. Now, this is if you're the seller and you're the note buyer, but you've got to remember which hat are you wearing. If you're Barb the buyer, you could go in and negotiate a lower than market interest rate. We've seen people negotiate 0% interest rate. We've seen people negotiate no or little down if a property needs repairs. So you as the buyer can negotiate terms. You can have deferred payments. You might say, I'm going to start my payments a year after the rehab is done. It really depends on what the seller's motivation is. You just have to remember that if you get those really great terms as a buyer, that if that seller over goes to sell the note, that's going to make the note less valuable. So you just got to think about which side of the equation you're on, whether you're negotiating as the buyer or you're negotiating as the seller. And if you decide to do seller financing, a lot of these deals still have real estate agents. You still want, and there has to be enough down payment usually to come to closing for the real estate agent to get paid. Some of these don't have real estate agents, but a lot of them do. Attorneys and closing agents, you still have a title company. You're going to have an accountant, a CPA. You might have a self-directed IRA company if it's going into a Roth or traditional IRA. If you are selling a lot of these, you may want to use a mortgage loan originator to qualify your borrower. You want to be sure that buyer has the ability to repay or to afford the payment. If it's an owner occupant, somebody's going to live in the properties, buying the property, not an investment, it's possible that it's going to be subject to Dodd-Frank. Dodd-Frank does have exemptions for certain sellers that finance 1 in 12 months or 3 in 12 months. But if you're doing a lot of them, you might want to do an MLO, or if you just sell to an investor that's not going to live in the property, then that won't apply. And then we like to use a servicing agent. That's a third party who collects those payments from the buyer and applies them to taxes and insurance and remits it to Sam, the seller. It protects both parties. And if there's an underlying bank loan in that arbitrage situation, then the servicing agent will be sure that gets paid. That protects Barb, the buyer, as well, because that's the one risk in there, is that Barb sends her payment to Sam, the seller, and he doesn't pay that underlying bank loan. So a servicing agent can help with that as well. So just think a little bit, and we can explore these ideas in the Q&A. You could buy or sell property using owner financing. You could be a private lender. You can find notes and refer them to investors like me. We pay referral fees. You could buy a note and hold it for interest income. You could buy a whole note and sell off a piece of it. Some people like to buy notes and borrow against them. That's called a hypothecation. There's even people who like to buy non-performing notes because they want to buy the non-performing note, foreclose, and get to the real estate asset itself. I like performing notes, but some people like non-performing. And sometimes you can buy and restructure a deal. So if it was non-performing, maybe you can work out payment terms that work good for that borrower to get him back on track. So this is just a quick slide that shows my contact information, Tracy@noteinvestor.com, and I'm good about responding, and we have some free information on there as well. So this is a great time. What kind of questions? What do you think, Kaylee? Have you used seller financing in your I know you buy big apartment complexes, so it's not as common, but have you seen very much in your market?
Yeah, I always do it. There are some sellers out there because the market has been wild, that get 5, 10 million more than the property's worth. What? Yeah, it's been happening. So those
Wow.
situations usually they're like, I don't need they just don't want to do the brain damage, I guess. And it's really
Yeah.
not that hard if they've done it before. So typically I have to put together like some pitch for the broker and then say, because they don't want to either, they don't want to do it either. They're like, I don't really get it, like what, because there's a couple different ways to structure it. Like, what do they get? Are they going to be a lender sitting as a preferred equity partner? Because also, like, usually they want some kind of slice of the deal. They want to take a swipe of the income that we make somehow, and they want to guarantee it somehow, but they can't put a first lien on the property. So there's different ways to do it where we can pledge equity. We can like as a mezzanine lender, they can pledge yes. So answer the question, yeah, we have. And it hasn't been like we get, whenever you're negotiating, you always want to like come in, like if you've never read like never split the difference, like with that extreme anchor, like, yeah, we're gonna have you finance the whole deal plus 100% of the capital expenditure budget. And they're like, what's the number? Like they don't even read that. They're just like, what's the number? And if it's like too big, they're like, no, it's too high. And then we start talking, but um now it's getting more common. I think that, and of course, assumptions are becoming like really common. So I think this is a really, really good skill to have. But one thing that's in the chat that I wanted to ask was like, how do you suggest it? You know what I mean? Like, what are the signs that this could be a potential win? And I think the wins I've had getting it done always start with a conversation of like, what's in it for the other person?
Yes.
And there's certain signs that I see based on like their age and like what else they're trying to accomplish in their life, and certain things that they may not understand as far as like what they're really going to net, like if they sell it out right now. And so this is in a different situation, but yeah, so there's got to be buying signs. What would you say would be the way that you would suggest it, and what are you looking for this to be an appropriate strategy?
Yes, so you have to decide if you're the buyer or the seller, because that could be a different answer. So if you're the buyer, then you're looking for those sellers. If you're a buyer, the first thing I do is I say, find a real estate agent that actually understands seller financing, that actually in the MLS has some properties listed for seller financing, because not all real estate agents get this. And it does help if you're the buyer, if your real estate agent gets it. Now, if they don't be discouraged. You're just going to have to get really good at making those offers and talking to those sellers and keeping the real estate agent involved, but also letting you talk to the seller, because some real estate agents will even say, oh, I'm not even going to make a seller financing offer, but they're legally obligated to present the offers that, are made in writing. So it always works better, like Kaylee was saying, if you can talk to the seller and have a conversation, because you're trying to solve their problem. You're trying to see what they need out of the transaction. So why are they selling the property? What are they trying to accomplish? It's a little bit easier sell to an investor that has capital gains, because they know they're going to get hit with a capital gains tax, and you can show them the installment sale provision that they can discuss with their accountant, which will allow them to defer that capital gains over the life of that note. And so that is a really good strategy for investors. It's a good strategy for tired landlords, people who are just sick of being a landlord. Sometimes it's good for people in transition. I live in Central Florida, but I was just down in San Antonio because there's a big seller of seller finance notes down there. And we kind of all met up down there. And there's one seller who's got 200 properties as rentals, and he's getting up into his 70s, clearing 80, and he wants to start converting some of those rentals to owner finance notes, because he wants the interest income. He doesn't want all the capital gains, and he would love to sell them to people, that are that are wanting to do what he did. Like, that's how he got his start. So I think that I think those are good signs. I think anytime a property's been sitting vacant is a good sign for offering with seller financing. If there is an estate or a probate, if it's been on the market for over 90 days, If it's an oddball property, we see a lot of seller financing on mobile home and land. So those harder to get financed kind of properties. So it doesn't work on all deals, right? If the seller's got full price offers and the buyer can get conventional financing and they need the cash, they're going to sell to somebody who can get a loan or bring in cash. But there's a certain number, $27 billion a year, that does have seller financing. So you just have to put on your creative financing hat and make a lot of offers and kiss a lot of frogs to get some accepted.
I kiss a lot of frogs.
Kiss a lot of frogs, yeah. You have to date a lot of deals.
Life, I think. So when we talked a little bit earlier about, there's a question about who services, like what types of companies and what kind of fees are we looking at and how is that set up?
So there are a lot of servicing companies, and Texas has quite a few of them as well. Are most of your callers in Texas as well, Kaylee, or are they all over?
I don't know. Hey, y'all, if you'll do me a favor and if you'll put in the chat where you're coming from, that would be really helpful just to know. I know that Chelsea is, I know that Harita is, I know that Kimberly, nope, you're not. You're from, well, actually you could have moved. I think you're from Washington, same. Yep, Texas is so that we can just know where you guys are coming from to answer.
That's great.
Real data.
Yeah.
Sandy, you go.
So there you've got a lot of them in Texas. Off the top of my head, Moat Note Servicing is in Texas. August REI is in Texas.
Oh yeah, I've used them.
Pardon?
I've done a deal with them. My first note I ever bought, they did it. They did the servicing.
Really?
Yeah.
Excellent. Yeah, they're good. They're good. There's some like FCI is national. They're out of California. In Texas, you guys like to keep things in Texas. I don't blame you. So most people that do notes in Texas, like a Texas-based company. So yeah, but you just do want to make sure your servicer's licensed to service notes in your state and that they work with private investors, because the companies that service the Fannie, Freddie loans, the FHA, HUD, they aren't the same servicers that service for private investors or seller financing. But there's quite a few of them on our website, noteinvestor.com. We do a best of notes where everybody votes on who they think the best servicer is, who they think the best MLO is, who the best note buyer is. So we do that every year. And so on there's a list of all the nominees. And I think the servicing categories like that and the self-directed IRA companies are the biggest categories for voting. So there's a lot of them. And the fees are, usually there's a setup fee. That varies. Some places it's like $100, some places $200, but the servicing fee ranges between $20 and $30 a month. It can be a little bit more if they escrow for taxes and insurance, or if they have to remit payments to an underlying, like a not wrap scenario. But it's not that expensive. They don't take a percentage like what you think of a property manager does. They're just collecting that payment, and they do things like do the 1098 interest statements at the end of the year. If people get delinquent, they'll send out the notices and the payment coupons. They take payments, online. There's a portal you can log in. So I think it's pretty reasonable fee for what they do.
Okay, so I'll tell you guys right now, like this is not in the chat, but I just thought of it. Like my first seller finance note that I was going to set up, I royally screwed it up. Like I had an opportunity on a really crappy house that I redid everything on, and I just couldn't find someone. I ended up finding someone to put into it, but it seemed to be a very good fit for those who wanted a house and wanted the backyard and wanted the space, but it was kind of like a tiny house, but not tiny. Anyway, so it was a good fit for people that wanted to sell or finance. So I was like, okay, well, how do we suggest this? I royally screwed it up by basically not understanding that what they needed to see like upfront for me to know what their monthly payment was going to look like, because like basically for them, that was going to kill the conversation. So if I just wanted to know, do you want, like, what is your budget was the first question I should have asked. And then I should have backed in to it and said, okay, well, then the term's going to need to look like this. And then the down payment's going to need to look like this. And, what is your budget for a down payment? I just murdered it in a bad way, because I was like, oh, you need that payment. So it's going to look like a 10-year term. And they lost it because they're like, oh, I'm like, you don't need to pay it off. Like, I mean, you can, but if you want the payment to be $200, like, here's what we got to do. So how do you not?
I think like just asking questions, like you were saying, trying to figure out what their ultimate goal is, because you can, pay it off faster, you can pay it off slower, you can have, a longer term, a shorter term. There's such things as interest only and balloon payments, although we tend to avoid those for buyers who are going to live in the property. That's more of an investor buyer play. So I think you just, like you said, you just have to know what their goals are, because you're trying to structure a transaction that'll meet their needs. And they do, some people will only sell if they do pay off that underlying. That's their motivation for selling. So you just have to understand that. You've got to know, what they're going to use the money for, how much they need. You have to say it in a nice way without getting too personal, but you still got to ask the questions. And you can also, you need to know how much they own the property and whether that's current or not. That's a good question to ask, especially as the market tightens and the economy gets a little shaky.
Let's see, what else do we have? What is, do you know what AITD means?
Yeah, so whoever put AITD in there knows RAPS. So AITD stands for All-Inclusive Trust Deed. And so in Florida, we have mortgages, so it's an all-inclusive mortgage. So you have them in Texas too, an all-inclusive deed of trust. Basically what they are is they say, hey, everybody, we're going to let you know that Sam the seller still owes money to Bank of America. And when he sells to Barb the buyer, he's got to disclose that. And so that all-inclusive trust deed is basically saying it wraps that underlying bank loan. It reveals it, it discloses it, and it tells everybody what their rights and obligations are in that scenario. So they usually say, Barb the buyer is going to make it their payment to Sam the seller, and Sam the seller has to make their payment to Bank of America. And if Sam the seller doesn't make the Bank of America payment from Barb, Barb has the right to go around him and pay Bank of America so she doesn't get foreclosed on. And if she does that, she gets a reduction from Sam the seller from what she owes him. So it's really just a good document that protects everybody. And so whoever put that in the chat, they definitely understand what a wrap is, but it's just the right way to document it. So all parties are protected. And wraps almost got outlawed in Texas for a little while. It didn't happen. We all banded together and lobbied, but people were taking advantage of the buyers, because think if Sam the seller collects Barb the buyer's payment and doesn't pay Bank of America, they can foreclose. And now poor Barb the buyer's out. Right. And Sam the seller's like, well, I don't care, I got my money. Right. So that was wrong. And it's very wrong. And so there was legislation, and so things like AITDs, all-inclusive trust deeds, and disclosures protect all the parties and keep everyone safe and keep us being able to do those kind of transactions.
100%. So the person that said that said, I purchased my first property, AITD. I'm a real estate consultant in San Diego, and I understand AIT is very rare. Someone else said, yeah, we have San Diego, Utah, Washington, Dallas, Washington, and Florida. If I take a seller finance deal as the buyer, then I can refinance with lower closing costs in X amount of years, correct?
Yeah. So you can refinance and pay it off and hopefully get a lower interest rate. Or, I've been a buyer of seller financing, and I've gone to my seller when I was ready to refinance. I said, hey, would you like all cash? Because I was thinking if you were able to offer me a $10,000 discount, I would be able to pay you off early. And they've said yes. So if you do that, make sure that they might say no, but it only, you don't know until you ask. So a lot of times they'll say yeah, because they like to go do something with that money.
Awesome. If you guys ladies have any more questions, just stick it in the chat. We can answer it. I do want to take a quick break to let Chelsea Hobbs, if she is hopefully able to get on audio, and to introduce herself. Chelsea sponsored this event, and Chelsea works with me when it comes to insurance. So when it comes to property insurance, and boy, do I have some stories to catch her up on, but my property policy is something that when I'm confused on what's going on with all the builders risk policies and the wind hail policy riders that I need to claim on and etc., they'll walk me through what I need. So Chelsea, we're happy to come back to you if you can't unmute right now. I know that I didn't warn you, but if you're able to come on and introduce yourself, please do.
Yes. Hi. Can y'all hear me?
Yes.
Okay. Awesome. Yeah, I'm Chelsea Hobbs. I work for an insurance broker out of Dallas. But we write all over the country. And like Kaylee said, I help her with her property and general liability insurance, builder's risk, all that good stuff, on her multifamily deals. I also work with contractors. Majority of my clients are contractors and those in the real estate world. So yeah, we're risk management focused. We review contracts, we do all that fun stuff. So if anyone's looking for any advice or any help, I'm a good resource. I have a lot of good resources at my company. So thanks. Sorry, I spilled my drink right before, right on my computer right before this. So I was like, I hope they can hear me.
Oh no, I didn't warn you.
No, that's not your fault. So anyways, I'm glad y'all can hear me. But yeah, that's me. I'll put my email in the chat. So if y'all want to contact me, please feel free.
Yeah, and the reason that I chose to have Chelsea a part of our group is because she's been consistent and she shows up, and also has a little bit of a background when it comes to caring for, like, getting actually involved in the community with protecting kids. You probably didn't want me to tell everybody, but you're a volunteer, and you can tell people maybe another time, but with an organization here that we have in Texas that is about advocacy for kids. And so for us in our properties, we want to get involved in the community and create a safe space for me personally. It's single mothers and women have a place to go home and be safe. But then also there are issues that come along with, maybe why someone moved into the complex. And anyway, Chelsea has a great heart, and she's been very consistent. I've known her for several years now, and she's always come to support these events in person, online. And even when we have in-person, like, women's tours of the properties, so as a character reference, I just wanted to bring that up. That's why I probably haven't told you that, why I keep wanting you to keep being involved. So thank you very much, Chelsea.
Yeah, thanks, Kaylee. And my email's in the chat. So yeah, thank y'all so much for coming.
Thank you, ma'am. And then Tracy, we've gotten a couple more things that have popped in. Let me, if it's okay, read those off.
Yeah, sure.
Okay, so if I have a deal I have been working on for over a year, the title owners are deceased. One of the
Okay.
next heirs died during this time that I've been trying to buy. Now the other heir is incarcerated. The title is getting hard to get cleared at this time. Is this a good seller finance deal? What are the pitfalls?
Wow, that's a story. And I admire you for sticking with it. The problem is, if you bought that and you let them seller finance, you don't have any guarantee you're going to get clear title when you pay them off. So seller financing isn't really going to fix a messy title. Maybe, depending on what your legal counsel, if your attorney thought, maybe you could get owner financing and you could have whatever you spent on legal fees deducted from that, or you don't have to start making payments until the until the title gets cleared. I mean, maybe there'd be something in there. I'd just be afraid that you'd spend some money and invest, and then you couldn't get clear title, and then you'd never be able to sell it yourself. So it doesn't, you provided temporary financing, but it doesn't solve the underlying problem, which is that messy title. It's going to take probably a quiet title action of some sort. I'm sure you've probably been through that with them maybe a little bit. Different states have different requirements of how to do that. But yeah, it's tough. I mean, we see a lot of people buying reverse mortgages right now, where it's basically where lenders have loaned to somebody on their equity, they're elderly, and they don't have to pay it back, and it's not due until they die, basically. That's how it works. And then when they die, their estate, depending on how the estate was, a lot of times people hold those mortgages have to go through all that estate and probate for them on their behalf. So if you could somehow do that for them, had a good probate estate attorney that knew what to do, maybe you do it with an option, or maybe you do it with seller financing, but that paperwork is going to have to get signed somewhere along the line by the person that has a legal right to transfer the estate's interest. That's a fun one.
Yeah. With it, I would definitely give you some cred there.
Yeah.
All right. Yeah, that was a really great question. I want to, let's see if we have any more questions really quick. I've got one more question. As far as, just kidding, we have another one. There's Tracy's information, by the way, in the chat.
Yeah.
If you're wanting to contact Tracy. Tracy, do you have any events coming up when it comes to learning more in-depth information about note investing, or being able to participate in one, or hands-on or book learning to do this?
So if you go to noteinvestor.com, which is the URL, that's part of my email, and you go to note that 101/101, you'll be on our email list, and we'll send you information on events. But we do events. Kaylee was kind enough to join us last year. We do 2 events a year virtually that are big 2-day conferences, and we do one specifically, Wise Women Expo, and that's kind of near and dear to my heart, because I really want to encourage more women to be investors. When I started in 1888, I worked with all guys, mostly old white dudes in suits, as my daughter calls them. And over the years, I see more and more women investing. And now we have groups like Kaylee has, and the Real Estate Invest Her group. And I just love to see that women are using all their skills in the real estate investing world. So that's what Wise Women Expo does. And so focused on female speakers, and men and women can attend, but it's a place to showcase female investors. And then my husband and I do Cashflow Expo. It just happened in February. That's 3 days, and we do 3 days of speakers on that as well. Believe it or not, we make those events free because it's kind of our way of giving back, and then we sell the recordings if people want them for a small fee. But those are our big events. And then we always do lunch and learns and free webinars. And then we do some training classes that are available for an affordable price a couple of times throughout the year and record them. So the best way to know what we're doing is to just get on our email list, and we'll be sure to let you know.
100%. We had another one come in. I love how interactive this is, by the way. I've told so many investors that are interested in investing or interested in learning just to get on here and just ask the most ridiculous questions, because we're all going to learn something, right? So the question I've got is, so I have a MOC on a year-long house transaction. Please tell me what the memorandum of contract allows me to do.
Well, tell me what the memorandum of contract says, and I'll tell you what the memorandum of contract allows you to do. I mean, that honestly, it all comes down to what the documents say. Usually a memorandum of contract depends on your state, but usually it just says, hey, I got a contract, but it's not recorded. So then you got to look at the unrecorded contract, right? If a memorandum is recorded, it's just letting people know of interest that it exists, but it doesn't have all the terms. So you have to look at the contract to see. If you're talking about a contract for deed, those are not done often in Texas anymore. They're not really a preferred document, but in some states they still are. A land contract, contract for deed, and that usually means that the seller is selling to the buyer, and the buyer is promising to pay, but the seller's not going to give up the deed to the buyer until the buyer's paid them all the way off. So in my example I showed you with the seller financing with a deed to trust or mortgage, the seller really gives the buyer the deed, just like in a bank loan, and the buyer gives back a note, deed of trust or note mortgage, and the seller has a lien on the property, but the buyer is vested in fee simple title. With a land contract or real estate contract or contract for deed, the opposite happens. The seller stays vested in a fee simple title and does not give the buyer the deed until they pay in full. And so there, you can imagine that there's been some problems with that throughout the years. And so the buyer does have an equitable interest, but not an interest on title. So it's a less, if you're the buyer, it's a less preferred way to go because the control is more with the seller. But we buy them and we see them. There have been some bad apples that used contract for deeds that didn't deliver deeds and things like that. And so they've sort of, a lot of states have steered away from them, including Texas. So I don't know if that's the kind of memorandum of contract you're talking about. Some people use an option agreement, which is different, or lease option, and might file a memorandum for that. But ultimately, it depends on what your document says, what you have the rights to do.
It's 1,000 long.
Oh, can you hear me?
Like a square.
Yeah, okay. So this is the same one that hi. This is the same one that I've been working on for a year. And so after the guy kept going in and out of the hospital because eventually he died about 3 weeks ago. So I thought, oh, okay, they're saying, the thing is to put a memorandum of contract on the contract that I have. I have a seller's contract on the property. And because we were going back and forth trying to get this title thing situated and him going in and out of the hospital and in and out of rehab and everything like that, I put a memo. I had a title company record a memorandum of contract that says that this is all I know, that says I'm, I have a contract. I'm telling the world I have a contract with this seller. But what I don't know is, okay, so now what? What does that, really mean for me?
You see all this stuff going on down here?
Have you talked with an attorney yet, or a good estate title attorney?
So the title company and the title company's attorney created the memorandum of contract, but there's no terms in it. It's just one sheet of paper. And it's just clouding the title basically. So they can't, they can't sell without my releasing that memorandum of contract. And that's what I'm asking. Is that basically what it's for?
Yes, it sounds like it. If there's no contract behind the memorandum of contract except the verbal agreement, then
no, there's a contract.
There is,
A
okay.
contract, yes.
Like a purchase and sale contract.
Yes,
okay,
definitely.
gotcha. Okay, I was thinking different kind of contract, so I understand. Okay, so that was smart of them to tell you to do that. It gives you something, right?
What?
So, but that doesn't fix the problem of the state that who has the right to transfer the property.
Yeah, that's still a problem.
That's the problem. But it was smart you did that, because now the whole world does know you have a contract, a legal right on that contract. So that was good to do.
Liz Pendens or different, but because Liz Pendens is like lawsuit, it's similar without a lawsuit.
Perfect innocence.
Are you talking to me, Kaylee?
No, Tracy.
I'm listening for the answer.
Well, I mean, it depends on each state, and it's going to be an estate attorney. They're going to have to file some sort of probate or Liz Pendens or quiet title action to name all the heirs and approve who has the right to transfer the title. It's going to be messy.
Oh, it is messy, but what I'm saying is if I just sort of back out and let them kind of figure it out, I don't want them to now go and circumvent my sales contract, so that's what I was hoping the memorandum of contract would supposedly, allows me to sort of keep somewhat control over them not being able to underpin me and go sell the contract to someone else.
Yeah, I think it was a really good first effort. I've dealt with contracts for 30 years, and they're a piece of paper, and recording the piece of paper helps, but it doesn't make people do what they're supposed to do.
Yeah.
So if they're going to be dishonorable, then they might still be dishonorable. But it doesn't sound like that's the case. It just sounds like
No,
it's very messed up and they don't know what to do.
right.
And I think I would ask the title company, what's the next step to be able to start a lawsuit to clear up the title, and who would they recommend? And then you could talk to an attorney and see what they would charge. Because somebody's going to have to fund that
lawsuit?
money. Well, I mean, it's a
It's-
type of
it's a
like,
lawsuit?
it's a Liz Pendens, like Kaylee was
Okay.
saying. I'm not an expert in probate law in Texas.
Right.
So it's a little bit different in each state, but it's it's some kind of Liz Pendens, a quiet title action suit. And so somebody actually has to file in the courts and notify. It's just like when you go to a foreclosure, you've got to notify anybody who might have an interest on the property of what you're doing. And they all get a chance to respond, and you go through the steps, and then the title is awarded to who they think it should be awarded to.
Yeah.
And then that person can sell it.
Yeah. That's where we are, or going, or trying to get to.
Yeah. Yeah. So it's going to take an attorney, and somebody's got to front that money. That's where, if it's you've got to make sure you're protected.
So, but the lawsuit, is that a lot of money? So far, I've only heard it's $300 per affidavit of heirship per heir. Ugh.
I'm not an expert in probate
Yeah.
law in Texas. I don't
Yeah.
know. If somebody is, please jump in, but I don't know that answer. I'm sorry.
No problem.
Yeah, the only person I know that knows that stuff really well would be someone that's not what they do for a job. They just would, I witnessed them staying up on the phone all the time, calling everybody and figuring out how to negotiate things. And that person is just like a whiz at it when it comes to like Dennison Sherman. So I don't know but basically they don't hire attorneys, and they just, I don't want to like, because I do the same thing. Like, I've gotten into this place where I hate attorneys. And so I've started to do a lot of pro se cases and like basically know my property rights or owner rights as a property owner, and then like counties will, for a minimal fee, actually let you file your own lawsuits. And there's like templates out there with the county, as long as you just know under what property code, you have rights to X, Y, Z. But I think some counsel's always good for advice. So I go talk to 10 attorneys for a free consult for an hour, and then I'm like, these things lined up. So that's what it is.
I like that,
You're a
Kaylee.
smart lady, Kaylee.
Because I don't like being played, I'm just tired of the whole like, oh,
Amen.
you have emotions, and I'm going to play you and drag this out forever because you have emotions, so
Mhm.
had enough of that.
Yeah, if you could figure this out, you'll have a whole way. You could make a whole living out of just buying these problem probate estate cases. Yeah. She's like, no, I'm done.
Do you have any connections with Dallas Rhea?
Mhm. Of course. Yeah.
Guarantee there's someone in there that does just that.
Yeah, they're the ones that's the title company. They're the title company that I'm using through
Okay.
their Dallas Rhea.
Okay. Well, thank you so much. Tracy,
Mhm.
thank you so much for going in depth when it comes to note investing, how to kind of wrap your mind around doing it, what all is required, the team. I think that a lot of this, when I did it for the first time, that's probably why I screwed it up, just because I just didn't know what I didn't know, and I tend to like just try it. So thank you.
Sometimes that's how you learn best, right? Just doing it.
But thank you for setting up for those of us who maybe have a little more analysis paralysis and don't like to just stick their neck out like me. Thank you, Raquel. And I'm going to have our next, our host come up. Harita, I'm going to ask you to unmute in a second so you can come in and introduce kind of the structure of what we're doing. So we started off with a welcome with our first guest, Tracy. Normally what we do is, so I'll let Harita do it. Here, Harita, I'll bring you on. So I'll unmute you real quick, and then you can tell everybody what's next.
We'll have the next meeting in 2 weeks. Actually, we have to decide about the topic, right, Kaylee?
Well, first,
But
we have,
it will be something,
our meeting normally is a guest speaker, and then we have a market update, and then we do Q&A for our, so next up, go ahead.
Mm, yeah, now we can do a multifamily market update.
Right. Okay, and
You
then
want to go ahead?
yeah, I prepared. If anyone has any questions, by the way, feel free to stick them in the chat. Tracy, if you have to go, feel free to do so. Thank you so much for jumping on. What I'm going to do is just give you a little bit of a snapshot. If I can swap my screen to show you an update I just got from National Multi-Housing Council. I'm one of their diversity, equity, and inclusion, I don't know, DEI board members for the last couple of years. And so I get these, they're a very big aggregator of data. And let me see if I can share my screen. And I'll just take you through.
I do have to run, Kaylee. I just want to say thanks for having me. I really appreciate it. And
Thank you,
yeah,
Tracy.
take
And I
care,
love-
everyone. All right.
I love your hair, by
Good
the way.
night.
Thank you, Tracy.
Thank you, Tracy. And so that's another thing that we can cover. So for all those listening, what we really want to do, as I pull up my screen, please start commenting in the chat here, what topics you really want to cover the next 6 months. So what we want to know is fears that you have, things that you're going through right now that you don't understand, things you haven't even touched, because you know, like sometimes I have a reaction to something just like, oh, I'll never do that, just because I'm afraid of it, you know. And I think that the more education we have of how to make money and the pros and cons of each, making it real, the more success we can have as a group. And what I really want to do what we're going to do is every 6 months, so twice a year, we'll have an in-person meeting where we'll share the performance of these investments that we're doing. So have Tracy pop on for 10 minutes and say, I invested in these 10 deals. Here's what we ended up doing. Same thing with me with some case studies and all of our different investments. So then we can actually not be afraid to take action and move forward. So please put in the chat any kind of investment strategies you want to learn about, especially if it has something to do with a real asset. So we've covered in the past investing in gold. We've covered in the past investing in cannabis. We've covered in the past investing in self-storage, multifamily, sort of like that arbitrage methodology to Airbnb and like short-term rentals, midterm rentals. There are definitely a slew of experts that we can bring on to talk about each of these things. So please put in the chat what you want to learn about so that we can do that for you. And I will figure out how to share my screen. There we go. And you guys can see the millions of things I have going on back here. And this doesn't look as bad as it used to. Let me open this thing. I'm going to share two things. So one, just like general trends right now in multifamily real estate. So this is kind of far away. If you can't see it, I'll just hit some of the high points. So we are so hyper-focused on the pandemic and all of the things that happened with that after, during. I mean, it was a very stressful time for myself. Now we're finally starting to come back to look at housing affordability, which is really important. And that's something that in the meantime, while people continue to develop more multifamily, I can really just speak for Texas because I'm really paying attention to it. We did invest in Phoenix. And by the way, we exited. I'll show you a case study in a minute of our exit on that one, but that's not really where we focus. As you can tell, that deal was going to be good. And so that's why we, squirreled and did something out there. But really housing affordability has more to do with how much it costs to be able to live in that unit. So maybe smaller units that have less fancy fixtures, being able to build a property with a government grant involved with the building of the property. There are different ways that you can structure your loan or your financing on a building. So there's also things I'm learning about now, which we'll cover in the future. If that's in the chat, if this is something you want, I can cover it. We're like, how do we stop paying property taxes? Okay, so we can be like a nonprofit. We can also have a certain percentage of the building used for a certain type of charity or cause, or there are certain kinds of vouchers that we take for a certain percentage of the units. There are things that I'm learning about now that I want to bring to the table to be able to make it more profitable and also make it to where we don't have to jack up the rent so much because we're not paying like our biggest bills or taxes and insurance. If we're saving on those somehow, then maybe we don't have to follow this incredible trend with the market, year over year to be able to meet our investor returns. Maybe there's another way to meet the returns and then also have the ability to juice the rents for the next buyer. So it makes it a very attractive buy, and then some other things. So point is housing affordability and sustainability is going to take public and private partnerships. So that's one thing we've seen a lot of skew when it comes to Section 8 housing, LIHTC housing, things like that, where the government is in control of those programs. And they're really not making it feasible for, people that are individual owners to participate in these programs. I started to learn about LIHTC and some others myself, and the reporting requirements, the weird things like you have to have a property manager that like only has done LIHTC type housing, for example. There has to be these certain LIHTC meridians in the property, like basically like a measurement above sea level that it's really complicated. You have to have a certain number of computer centers in your property. If they go out, then they don't have to pay the rent for those people that are trying to access the amenities. There's a lot of rules, and those are just some, right? So there's a huge disconnect. Like, why would an individual owner ever want to mess with that? That we wouldn't, right? And then also it's been proven by some of these factors here that I'm not going to read every word, but that developers are proven to not go into markets where essentially rent control is a thing, right? So that means that those markets are missing out forever, or for however long the government is regulating that area, or however long this program that's being ran is taking over a majority of an area. That area is not going to have new development, new restaurants, new shopping, new jobs being brought in, and basically be able to, what we want when we're developing things like that is usually there's some kind of initiative to reduce crime. All over the gentrification of a neighborhood is something that benefits the neighborhood. So if developers are avoiding the neighborhood because they don't want to deal with all this extra red tape, if you will, then that's going to hurt the community, or not it's going to hurt the community. So this was something that there is I don't have it put here what the acronym is, but under NMHC, National Multi-Housing Council, they have a PAC that is representative of multifamily owners, and they go negotiate with the government to try to communicate with them, what is not working, what is working. And so it's been discussed at depth in January, and then recently, what kind of programs how can we tweak the program to where it's a little bit more reasonable or feasible for an individual owner to be able to implement it and be able to keep with these standards. Also, what are we doing to be able to continue to pay market rent or higher? What are we doing to be able to, these individual owners, we want to be able to bill back the utilities and other bills to our residents. And so far, we've had to get really tricky really creative when it comes to getting, we've had a few Section 8 tenants, and getting really creative when it comes to the case worker and presenting to them the payment at market rent. So what we have to do is we have to take those bills and we have to prorate them based not even on the RUBS formula, but we have to basically itemize out in their at least addendum, what we're going to be charging for each bill, and then and that's on our end. And basically with them, what they're getting turned into them as an application to their caseworker is it's one base rent. We don't itemize it out for them because then they won't pay it. Then they'll only pay the base rent. So anyway, we've had to get really creative, and that's a little bit ridiculous too, because anyway, point is that there's been some conversations between the government agencies, Freddie and Fannie, with lawmakers as well, and then NMHC for making it more feasible for owners to be able to participate in these programs, but not have it be so restrictive. And again, that reduces barriers to construction and rehabilitation, which would be the way to address housing shortages. And we need to leverage federal resources to incentivize better housing policy and decision-making and planning for the state and local level. We need to also focus on preserving and increasing the level of diligence we're doing with resident screening tools. So that's something that we have actually partnered with. I don't know if you guys have noticed this, but when I was featured recently in AAOA, American Apartment Owners Association magazine, Rent magazine, that they actually, when you're a member, and I provided everybody a link that gives you a free year, because we won a free year subscription to this service. They'll give you your resident screening for free, and then for a discount depending on how many bulk screenings that you're actually implementing. And so what that's helping you do is to make sure that your properties are filled up with the right people. And then also they give you a couple of other tools that integrate with softwares, depending on what you're using, to be able to kind of keep track of everything in one place, so it's not so scattered. Another big thing that we need to do from the housing industry, from the government in the housing industry, and then in general, but this is already happening. I have a friend that was involved, and this is in Dallas, Texas, majority that I know where it's going. And I forget the name of the bill, but it was the there were two. There was the Inflation Reduction Act. It has a full name, I'm sure, and the second being the semiconductor bill. I don't remember the names of the bills, but that they were passed recently. And so these are specifically meant to bolster infrastructure. And so I know that one of them, and especially coming in the future, there is a infrastructure bill that's supposed to be passed. And so these guys are talking to the government about this. How do we catch funds? How do we bring this in here? How do we benefit, right? So infrastructure meaning roads, storage, meaning airports, overpasses, better corners for cities, better water drainage systems, better water treatment plants, like all the things that are helping us to be able to grow as a community, and then also travel and participate in business and commerce. So there is actually a heat map that is going to be in the works, just so you know, as a part of those bills that were passed, but in the infrastructure bill coming around DFW Airport. So for example, if you ever paid attention to opportunity zones, this was something that, so just the pattern here being that the community and the government needs to support the development and infrastructure needs that will impact housing and support future housing opportunity. So around DFW, literally all the roads that are around the I don't know, it looks like an upside down helmet kind of DFW. That is all read in a heat map similar to opportunity zones, where they had heat maps that said, okay, your incentive for investing here or having product that is made here or shipping from here and doing commerce in this area, for example, you'll always have some kind of tax benefit. So that is coming if you are investing literally in property, like real land property that is right around the DFW airport. So just know that if you find an area that's priced really well, I just really try to focus here now. That's also something that we've done, is change our strategy, where we're no longer going to be doing deal ADD all over the place. And I thought Texas was a concentrated place. Nope, we're going to be focused in a couple of zip codes, and that's it. So that's just local intel, right? But this is a general thing that needs to be taken care of nationwide. So everyone needs to, the government and local business owners and local government needs to focus on infrastructure. Also accelerating broadband deployment. That's something that we really haven't had much focus on, I suppose, but as people are moving out into the suburbs and the more rural communities, it's really important that there is broadband development so that everybody can be able to work. I mean, we're online all the time, right? And so without being able to get online and do your work, get online and be able to have calls like these, it makes it impossible for those that are a rural, I'm not saying that right, people that live in a rural area to be able to support their families and be able to learn and grow and share resources as a community. You have to communicate. And then just skipping over a lot of it. We're also, no, not we, I'm not part of this task group, but National Multi-Housing Council is working to talk with Freddie Mac, Fannie Mae, about adequate capital financing. And so there's some programs they were running for affordable housing. And that doesn't mean Section 8, that just means like the crappiest property in the neighborhood and being able to bring it up to standard. There were a lot of benefits to the loan rate, terms, prepay, basically all the things that cost money, that the debt financing, the cost of financing, basically to bring it down, to be able to have people come in and make all those changes and be able to impact the community. They got a benefit for doing that, and those are kind of going away, or they're changing quite a bit as we've continued to originate loans. I'm kind of surprised that we have to be really creative again in the way that we phrase about, like, oh yeah, this is around the corner and this is the kind of property and this percentage of students lives here and this percentage of people that work in a blue collar job live here. We really have to be creative. So it's better to, I think, bring that back in full force. And then also ESG programs. So environmental social good programs, where you actually would get a economic benefit as an owner from employing these programs in your property. they were doing that for a little bit, but that actually went away, which was really sad to me. So meaning that, you know, environmental, we all know, like LEED certified buildings, things that are reducing energy consumption. Some of those things involve plumbing or water conservation, electricity conservation, and some other things. That was a big thing when like Fanny Green was like hot, you know, and now that's kind of going away, but it's still around. But then the S, how do we benefit financially from doing social good in our community? So to me, that means helping people with their credit scores, helping people to be able to understand what it takes to buy a first home, helping people to understand the best ways to feed their children, helping people to understand, like, just to have the skills that they need in life, right? And currently there was something through Isuzu, and Freddie and Fannie have millions that they've been given by the government to participate in programs like this, but they pulled that program. So what they were doing is they were giving owners who started using these programs that I'm mentioning, they gave it a package program. If we implemented it on our properties within a certain amount of days for a certain amount of time, they would actually give us like the agency would write us a check, you know, on closing of the loan into a Fannie or Freddie Mac or Fannie Mae loan, multifamily small balance specifically, but then that went away. So they're no longer, you know, working with or paying that company to be able to provide these programs or to be able to provide an incentive to the owners to do that, right? So you have to just continue to do it because you care, and that needs to be changed. So and then also, I don't know what to say on this. I know how I feel, but I'm not going to get political here because that always seems to polarize things. But it's obvious in the trend of looking at the way that the United States works, that it's important that advancing, or at least doing something to advance labor and immigration policy, because then that would ensure adequate workforce supply in all the areas in the multifamily industry. And this is specifically heavy, if you ask me, here in Texas, just because of, you know, the country that we border, you know what I mean? So I'm not the president, I can't make these decisions, but I know as a small business owner getting involved with these properties, how the inability to have hardworking, quality labor that also has trade skills that are built in a country where they manufacture glass, they manufacture metal, they manufacture a lot of products, you know. So so I know with my geolocation and with what we see with increasing, like guys and gals, the cost for services is double what it used to be in 2019. Like if you're actually tracking your expenses, so that has done a number on our returns, obviously. And so being able to spend more time with a better immigration policy, I think, would be fortuitous. But again, I'm not the president. So these are just trends that we're seeing in the multifamily industry. I'm going to jump out of here. If you want a copy of this, I'm happy to give it to you. And then, so that's pretty much like the update. And this is not the update that comes to like the lens of finances. Here's something I do want to give you. So this call is going to be recorded, and I upload it into a portal that we have that has our education content for later use. And you can look at all the past events we've done. You can access legal documents, all the fun things for being a member with us. But then also you can look at this session later if you'd like to, and then we'll attach other documents. So if anyone wants this, I'll look in the chat in a second for your suggestions for topics in the future. But I do want to share that I have a whole bunch of these things, and I'm curious if you want to comment if this is helpful for you. So for example, as we have gone through a lot of refinances and originations this is specific to multifamily. So this is not specific to other investments. We have created an SOP, or standard operating procedure, for how to do so. So, you know, as we've done, like I just did my first Fannie Mae loan. We've done Freddie, Fannie, CMBS. I've done my first one, these checklists or SOPs that look at what is all the terminology of what you're reading. And then essentially, before you even talk to a lender, what you need to be doing as tests for all of your numbers, to be able to talk to them intelligently on, hey, here's the proceeds that we're going to hit. Here's why we're going to hit it. But mostly, I think it's important for me to be able to, I use this to copy and paste like these checklists of what you're going to need to put into a portfolio. We put it into like a file, but I tell all of the other principals on the deal, instead of emailing back and forth like psychopaths whenever we're doing this, so it's so stressful. instead, like, by the way, these are all the things that you can negotiate on a loan. I didn't realize this. There is also a group chat of women that are operators. Whenever you become an operator and you're like dealing with all the icky stuff on multifamily and you're like, I don't know how to stop being bullied, or I don't know how where to buy a trash compactor that's, you know, the size of the facility that we need to fit, etc. This is really handy, but these are just processes and procedures. So for example, once we've looked at what we're going to ask for as far as a loan, and we know what to, you know, tell them we're not going to sign on when it comes to the terms, then here's, like, for example, the checklist of all the things that need to be in your buyer packet, or sorry, well, it's either on a origination of a loan if you're a buyer, so your buyer packet, or your refinance packet as a team. And it just helps to make clarity on like who's responsible for what you're going to have to sign. And there's much more when it comes to the actual property itself, but hopefully you have a property manager, and hopefully you can just ping them and send them like, hey, we need 10 leases. Hey, we need this environmental report. Hey, we need our fire inspection report. Hey, we need all this stuff that they should have on file. So these are just some checklists, and this is an example, since this topic tonight is about loans and is about capital markets. Now, if you look in the chat, I'll quit sharing my screen and then I'll come back in a second. If you want to look in the chat, I'm going to look for some suggestions, but I also dropped 2 links in there for you. So if you're like, okay, I haven't been doing this very long, how do I figure out what's going to happen with loan rates? Honestly, if you look at a 40-year spread of what's been happening in the past over the last few cycles that we've had, you can basically see the patterns of the government's bond buying and how that correlates. It's not exact science, but how it correlates to what's happening with interest rates. You know, their bond buying goes up, interest rates go down, and vice versa. And I don't know the math on that, but that's just what happens. So how do we know it's going to happen though? Like, it's great that that can happen, and it will. Oh, it started happening, but by how many basis points, or how many, like, is it 10 percentage points? Is it 1 percentage point? Is it half a percentage point? And how often is it going to happen? The only indicator right now that I've been able to have, because I don't have a crystal ball, is on those links that I dropped in there. So essentially there's 2 places that I look at, depending on if you like Twitter or if you like the web, whatever your thing is. So basically the Federal Reserve, Jay Powell, he is the one that basically says, hey, this is what we're going to do in the next so many weeks. This is what's going to happen with lending. And pretty much it just follows what he says is going to happen. Time to time, it may not happen like next week, it'll happen the week after. You know what I mean? But whatever he says will happen, will happen. Where he gets his data from, or like how reliable he is, but he is being followed. What he says is going to happen. So that is a place where you can go look at the events that are scheduled to happen with the Federal Reserve. So that is the calendar that they have. And so you can search by Jay Powell if you want to, and stick that in your calendar. And so there's no surprises, there's no drama, there's no like, oh, I didn't know that was going to happen. He will tell you it's going to happen before it happens. And then Twitter, again, if you're just a tweeter and you like Twitter, that's another place to look at the Federal Reserve's information. So I wanted to drop a little bit of information on loans, a little bit of information on where to get more information, or where to track the Federal Reserve. Tracy helped us today with more information about notes. And then we do have 2 topics, or 1, that we'll cover in the future, it looks like. Involving the STR short-term rental space, the regulatory processes. If anyone knows of an organization that is clearly making a difference in that space in Texas, please connect with me. So if we want to go over regulatory changes, and like kind of like a lobbyist group, like a PAC, like I mentioned, but it's obviously for short-term rentals. My friend Amanda, we actually share a brokerage license together. She would be the one to talk about that. That's literally all she does. Midterm rentals, short-term rentals. She has a boot camp on it and does it nationwide with other, not sponsors, but kind of like other operators. You know, she'll walk them through the process. So I would say, Harita, if we want to do something on short-term rentals legislation, obviously look up lobbyist groups, but that's something that to I would say Amanda Williams, the traveling realtor, and then maybe Chloe Cohen, if she's still doing it in New York. And then I'm trying to think, short-term rental shop, Avery. If you just look up short-term rental shop Avery, and then she's come on before, so they'd be able to know what's going on. So that would with that question. And then another question is how to become a syndicator or one of the general managers of a multifamily deal without a commercial track record except 20 years single family residential. How much would a general partner have to bring as a minimum to the deal? So if we're asking about the way that we do our deals, I am in a space right now where I've gone through a lot of heartache in my career, and one thing I've learned as far as being able to take on a brand new person in this space, it really would take a relationship with that person, like personally for me, because it depends on like how that person handles stress and how that person, like I've really had to work on the way that I speak to other people and my tone and things that I'm like not even totally aware of, because what I've learned is that you're responsible for like large teams. And so really, if you get to the point where you can make people feel really good about what they're doing well and empower them, like I've had to relearn my communication skills, everything, that those are things that I only had to do whenever I was responsible for a lot of stuff and a lot of people. So that's something that I would want to build some rapport and build a relationship and really see like where we can add value to each other first before just like jumping into a deal. One thing that we have done though, in kind of a hybrid scenario, is we've had two things happen. We've had a 1031 exchange person who did not want to work and they didn't want to actively operate the deal. And they said, okay, how do I get the tax benefits being on the GP side, but not actually be a GP? And I'm going to bring in a chunk of money and be able to basically be a GP without having to deal with all the heartaches and staying up all night. So we've done that for them before, where we have a program where they can do a tick with us, and then we'll do a side letter with that person and work out an agreement where we're able to make the decisions when it comes to operating. Now, when it comes to taking in a new partner, we've done this with, like, for example, a doctor or a CPA or a group that says like, oh, okay, I've got like 500,000 or 250,000 or so that I want to put into the deal. But I want to do the accounting for the deal, for example, right? Now we have kind of gotten to a point where, next purchase, there are people set in place to do these things. And so we don't really need someone to come in and volunteer to do a certain role. However, I would say that those professionals that come in, first of all, they've owned a business, so they're usually accredited, and they seem to be very, not laid back, but just really reasonable when it comes to stuff that seems really scary. I don't know. Today I met with someone that I told them about our loan being called, on a deal not too long ago, where the average person might lose their mind. And I've been in deals where they lose their mind on the other partners instead of putting their heads together and trying to come up with a solution, just because it's a fear response and it's something they've never seen before. So I would tell you that, like, in my role now, that every day there's something new that pops up that I've never seen before. And so I just choose not to react to it anymore. I'm like, there it is. Okay, there's another, I got to go to sleep, and then strategize and be like, how are we going to do this one? But yeah, so it's just, we got to be very careful about who we partner with. And so there's two other avenues to kind of jump in, like as I mentioned, a 1031, or if you have a large grouping of capital, sometimes we can go ahead and stick you with a share class where you're a preferred investor. And so what that means is, like, the bills get paid, the lender gets paid, and then you have a preferred return that is paid out, before the other investors. You get a preference. So that's how we've done it before. But yeah, just definitely, too, like, what is that skill set? If someone wants to be on the general partnership team, the biggest things, right now, or always really, are like raising capital, bringing it to the deal, being able to bring in a deal, which right now is, I don't want to say impossible. Like, I finally got traction this last week from a broker who is willing to put off-market offers out to sellers that we know, like, one is going through a lawsuit for fraud. So they're going to have to sell everything. One, we know, there's just certain intel pieces that, like, brokers know, but it's just taken a long time for us to get them to be willing to do this and to start getting that deal flow. So yeah, deal flow, if someone's able to provide that, which, takes understanding our buy box. And then operations is the other, like, really big piece. That's something, as you can see by these standard operating procedures, we've just made so many mistakes, in the last 6 years, and trying to not do it again, that, like, I wanted to put these processes together. So really, that person that would be ops, if you will, is asset management. And so what I've also learned at this point is I have put together enough information to say this is our template of how we do things and be able to kind of hand it to somebody, but that somebody would have to maybe come from like a Camden Property Trust Group or come from another organization where that's what they did is they asset managed. And so then they follow our structure and then they implement their expertise. And then basically they have a data room, we have meetings, we have ways that we communicate, you know, what is the bottlenecks, what is the plan, what are we going to do to because our focus right now is scaling. So it would take a couple things like a 1031, an active, like great skill set that's already pre-established, or really, like I said, just kind of like getting into our world, as far as finding a mutual place that we both can benefit. You know, like there's a lot of things in the world that I don't like doing, and would love to not do them, because right now also I would prefer to focus, and I'm doing like all the things, and I cry at night a lot, you know, because I don't want to do all the things. So that's the long answer to that question. Let me share something with you guys, which I think I'm excited to share. This is something I put together recently because as we need to raise capital from private equity groups, we need to raise capital from family offices, etc. I've been working with some preferred equity brokers, and so we now have a website that is a resume website of, you know, who I am and what I've done, but also like what is the team done. And I hope you can see this because I kind of can't because it's covered up by all the Zoom buttons. But essentially, this is a case study of that Phoenix deal that we did, which is nuts. I mean, like a 3.67 equity multiple is not normal. Like it's really not. And I just put this together because I would like to present them too. And I'm working on the second one right now. You can't see it, but it's like best case and worst case, like what's happened. So this is like the best case, and I just happened to not be done with the other one yet. So I wanted to show you guys this. We sold this one off at the end of last year. It was I think it was like a $9 million raise. It's been a while. But it was a 236 unit property in the northeastern corner of Indian School Road in Glendale / Phoenix, Arizona. We purchased it in 2019. We bought it for 16.7 million. It was basically, these are, I don't know, you can't zoom in, but the top left picture is what we bought it, what it looked like. And then over time, as we changed the amenities, the front office, the front entrance, the kids area where we had monthly events for them, the signage on the road, the security, we were able to take this. It was sort of like a converted motel into multifamily. So they had done kind of the hard work, and then they were not increasing rents, not operating it as a value add property where there's so many other things we could do to make money. So we ended up selling it for $37 million. And so that was 221% over. And our rent, we came in at 2.1 million in rent, and then we exited it at a 3.2 million in rent. And that's GPR, gross potential rent. And then other income, we went from 90K to 562K. So that's what we mean by value add, is being able to find things that we can add to the community that make more income. Some of that other income came from amenities with a platinum unit that we were able to do. But I mean, this deal was, I don't know if you want me to read it, or I can send this to you because it's too boring to read, but we noticed that the area was growing and gentrifying. We noticed that there were property or buildings that people were willing to take into an adaptive reuse instead of building brand new. And so then that's a sign that people want something nicer, but they also want it to be affordable. They don't want the brand new, I don't know, in this area, it's like a lot of money every month for rent. And so this property was in an area that allowed us to be able to put in these value add features or other income features, and people would pay for them because they're like, I'm still getting the same area that I like. And anyway, so I'm happy to send you this case study, but really overall, we were projecting to hold it for 5 years, so 60 months. We ended up holding it for 3 years, 38 months. We projected, like we normally do, to exit at 2 equity multiple. And our actual equity multiplier, like I mentioned, was a 3.59, not 67. So I'll have to fix that. Projected IRR was 15%. The actual IRR was 50%. Our projected average annualized return was 20% projected, and then our actual was 81%. Our projected total return was 103%, and the exit return was 259%. So as you can see, this did really well. And we had a massive fire here. I mean, there's 3 parts to the property and one was just gone, basically. So we dealt with flooding that happened from the fire, and then mold that happened from the flooding, and then a ton of units of lost income. For a long time, the city was very difficult when it came to getting zoning, permitting, etc. passed. We had to end up getting a settlement from the insurance company and then going with a public adjuster to come back to them and like basically sue them. So that was going to be the next step, but it's like the engineers came in and they said, hey, here's all this stuff that was affected by all of these issues, and you guys didn't pay for it, so you're going to pay for it or you're going to get sued. So anyway, we originally had gotten a settlement for like 800,000 on this, and then we ended up with a 1.8 settlement, and we pocketed 1.5 because we had to pay the public adjuster. But so then what we were able to do with that is we were able to finish off the amenities that ended up increasing in price a little bit because of supply shortages, but then also being able to test out some like platinum units that was not part of the normal business, the original business plan. And that's the great thing about multifamily, is that like you set a business plan to do certain things, and then you run into situations where you're like, oh, we can put gold in the toilet paper or whatever, you know what I mean? But like, there's something that can happen that makes you more money. And so this was the platinum units. And so we were like way over market with these fixtures of like quartz countertops and some other nice things. And so we just did, I believe it was a floor of those, and then showed the model to the next buyer that like, hey, this is what you can actually get with rent if you keep up the premium renovation plan. And so we were able to exit at just the right time, because let me tell you, Phoenix now is like it's totally a bubble. So there are units there that are like $300, $400 overpriced, honestly. So that this is one where if you're going to get in there, you have to have a really tight plan, and then hopefully a contingency plan to get out if things don't go well. So I just want to share that case study, a little bit about what's going on in our multifamily realm. I'm going to open it up for Q&A, and then I mean live Q&A. So you can either put it in the chat, I will put it out loud if you'd like, or just go ahead and unmute yourself and come on and let's talk about whatever questions you have. Like, no matter how silly they seem, they're not. So, and that's really what we wanted to have these meetings for, was to make sure that you're getting some education, and you're also getting some real time, like what's going on down in the trenches. And then on top of that, you know, hey, here's stuff I don't know. Here's stuff I want to know. The floor is yours. So I will let Barb and Brooke and Harita and Chelsea and I think Sandra, I think you're the iPhone. Ask whatever you want. Go for it. All right, guys, don't be shy. Let's see who was engaging a lot. Sandra was, Alex, she's off. Kimberly put the kids to bed. Bethany, she's off. Brooke, you're next. I'm going to ask you to unmute and ask any questions you've got. And then
I'm having issues even finding a broker that will talk to me.
yeah.
So,
What did
well, how do I go about finding somebody that will work with the first time buyer and not laugh in my face?
What do you mean first time buyer?
Well, I've never bought anything yet.
Anything like no house, no rental properties?
I had 3 houses at one point. I lost them all, and now I got to start over, and it's been quite a while. So it's like I'm a first time buyer.
I think we got some experience there. So go ahead.
Yeah, go ahead.
So one thing that we're always asked when it comes to like a lender relationship, I know that's not a broker relationship, but they will ask the same questions. If you don't have an SREO template, so a statement of real estate owned template, it does apply to anything that you previously had. Like for sure, if you look at mine, you know, on my new little website website resume, and I'll actually put that in the chat for you, because if you go there and you look at the second tab on CV, then there's actually a SREO right there, and you can basically like take that template and reuse it for your own use. But so properties that we've exited, I just highlight in red, that they're fully exited, and then what we did with it. Yeah. So the
Okay.
wants to know that and how I did it. Not that this was the question that was asked, but I had to have some dudes vouch for me. So I had to go find some other operators in the industry that had a little bit more success than me, like 2 exits, 3 exits, something. And then for people that I respected their character. And so I knew that the other people in their life were going to be very similar in character. At that stage and age, I didn't know what else to ask. I know now, let me tell you. But when it came to that relationship, that person ended up vouching and saying she can close, like, they knew I had the motivation to do it. And the first couple deals I went after were not huge. They were like 20 something units.
Okay, well, that's decent.
Yeah. Sandra,
Thank you.
you got it. How do I answer you, Sandra? Oh, you're on. Go for it.
Okay, you can hear me. Okay. Action. Go ahead. Okay, so Kaylee, can you hear me?
Okay, I'm back.
Uh-oh.
There you go.
Okay,
Yes, we can.
okay. Okay, so Kaylee, so I went to Grant Cardone's Real Estate Summit just this past weekend, which was very informative. And and I kind of went there because I wanted more clarity on where I needed to go sort of next in my pursuit of scaling. And I don't know that I got clarity, so I'm still working on that really. But basically what I'm thinking of at this point, that whole little summit, real estate summit, it's really kind of about multifamily. So it's a major push for multifamily. So sort of discourages single family, and it gave reasons why. So now what I'm thinking I should do is take my portfolio of 5 properties. I'm trying to close on the 5th one. And, once I get that one up and running and everything like that, then maybe sell the entire single family portfolio and buy into a multifamily deal. Where's the pitfall in that?
I think that depends on your goals. So that kind of happened with a partner on Luda May. So she had a 4-plex, which originally came from some other smaller homes. So she did a kind of a small multi, but it was not commercial. So, but she's also buying in Seattle. So it's like, you're going to pay like this much and get like this much. So she sold it off and then basically made some profit and then said, I think it would be smarter for me to invest in like Georgia, Florida, Texas, something like that. And so our mutual contact in Seattle, Leica, she ended up introducing us. And so we ended up, and we're very a tax-friendly state too. So we ended up structuring a TIC with her. So what she did was she sold everything at the time that she had that was small. And I think they even had like a mobile home park that they got out of too. And basically timed it right where they're able to get everything with the same 1031 intermediary. And so basically they have their profit with that same person. And then we have a whole program to structure a TIC or a tenant in common partnership with a syndicate. And so that's what we did with her. And so she was able to roll her money into a much larger property, like, well, obviously 4 units to 22 units. And she was able to do it completely tax-free. And then we did another one with our larger property out in West Texas, same TIC format. And what's going to happen to both of them is when it sells, we're going to double their money and they're going to want to do it again. They're going to want to move it into, well, so do we, a larger property, right? And then obviously they take the advantage of, and what that's called is ticking out. So they tick in to do that TIC or like tenant in common partnership. And then when we sell the deal in the syndicate, there's probably going to be people that don't want to stay in it forever. And so we're like, okay, well, we'll have to tick you out. So break up that partnership, pay these people in the syndicate off, and then come back together and tick into a new deal. And some of those investors are likely going to roll over from the from the syndicate group, but we can't depend on all of them doing that. Who knows? Maybe they will. That's what my mentor did. I mean, the dude moved into the property and then figured out, what does this really look like, which is a little crazy, but whatever, if you don't have kids. And then they ended up taking 1031 funds from that first deal and rolling it 4 times into new deals. And this was again during when prices were going down, like they're going down now, like they're down 20%. And I think it's going to keep going for the rest of the year. And so then you're basically saying, okay, well, we'll just keep rolling it into new properties, and ended up making them like 2,000% on their original investment. But it took a few, 1031s. And some people 1031 for their whole life. So anyway, point being that would be one option if that's something you want. A TIC, like I mentioned, is, structured a couple different ways depending on your partner. You can do a TIC as a active member. On your taxes, you have to be an active member, but like we have figured out a way with our guy in West Texas where he's like, I'm a commercial pilot for United and I'm like one of their executives. Like, I don't want anything to do with this. Like when there's something you need me to sign, when there is an issue, like if we all get sued, right? Like we're all going to get notice, right? He's like, just call me and tell me the action plan. Otherwise I don't care, And so for him that worked because he was so busy. A little bit more active role, that would be something that we could discuss what that looks like. So there's a lot of possibilities in the world.
But you think that getting out of the single family into multifamily would be a good thing though, right? Of course you would think that.
It depends on your goals, honestly, because like, with what you do right now, my understanding from an outsider's view is that you do the single family full time. So with that being full time, then what's the next thing? Like what do you want to do with your time if that money and the equity gets rolled into, larger assets? For us, so it just depends on.
I would want to take a more active role in that syndication rather than just being passive. Passive is kind of where I was going. And I think I've talked to you about that before, just so I could play grandma more. But it's probably not going to get me to the financial goals that I want. So I've got to, at least get active in the syndication part for, 1 or 2 deals. And, what am I going to do with all this single family property? I want to get to anything really. That is true. That's where I want to get. But I may have, I've got the single family properties. I need to 1031. That's what I'm thinking, really, into some bigger thing. And, ultimately cash flow is, is kind of my major deal, cash flow, not just a whole bunch of money sitting somewhere. So that's nice too.
Yeah, I would run an analysis kind of like, I'm not sure, what your cash on cash return is that you're getting from your rental properties. I would do an analysis on, I've got 5 properties. Here's the cash flow, here's the cash on cash return. Each of them kicks off based on the initial investment that I made. If that investment is less than 20% annualized, then I think from that standpoint, like a midstream analysis, I think then multifamily would be a good thing to think about. And that's just like the whole industry. But why I'm saying annualized is because, like, for example, you saw that one crazy good deal, how it was able to get this exit return, right? That didn't happen every year. So we basically would take that, do the math over the hold time and say, well, what did that net us annualized, So I'm trying to say, what is apples to apples if you're comparing your whole hold time on a multifamily deal. And that was a value add deal. I'm doing one right now that I hate, that is like a heavy value add deal. And I think that our portfolio is now going to pivot into something that's like light value add. It's not heavy deferred maintenance. I mean, it's more of like an operational play. There's something wrong with the way that they're paying taxes and the management is not managing it well, something like that. Versus it being just like a complete crack house, not really, but like I got where it's like old, that's the issue, old, like I'm not doing that anymore. So, anyway, so I would compare the two. What is your cash on cash that you're making annualized with all of your single family put together? What is that compared to? Because you should be getting about 20% annualized is our goal for multifamily. And then when it comes to like an active and passive role, really like the GP versus the LP, the difference in returns, what's interesting is the only difference is really when it comes to the fee structure. So like, let me see if I can share a screen. This is one where I can give you like a pretty okay example. Get out of here. Of like the fee schedule, and market fees are all different, right? But let me see. You can't see my screen. Share screen. But there are fees that we charge, but essentially there's a split. And so I don't even know. Oh, you're seeing my whole screen. Okay. Let me show you. I think this might break it down. I might have to go to the portal. Because that's what general partners want to know. This is something we're under contract on right now, by the way, that was under contract last year for 54 million, and we're under contract for 40. So this is one that you're seeing that 20% price cut. I'm trying to see if there is a slide that discloses the fees. So basically for me as a general partner, the biggest bump that we get is on the side of not really the fees, because you have an acquisition fee up front, but that varies. Like this, I think is like a 1% acquisition fee. I'll have to find that. But depending on your share class, there's different share classes. And this is one example in one deal. So you have class A, class B, class C, and these are dependent on how much money you're putting in. Your preferred return changes, and so do your splits. So this is a semi-complicated waterfall structure. But point is that depending on how much money you put in as an LP in this particular deal, you get a better split, like an 80-20 split versus a 70-30 split, etc. And then as a GP, what I really see you getting as an advantage is just major tax advantages, because you're obviously a real estate professional at that point. And so you can take all these K1 losses that we get. And then also sometimes there's portions of time where like we don't even take those fees because maybe it's not cash flowing or whatever. And so all these things add up to be a benefit. When you're operating, you take on a lot more liability, well, all the liability. So basically, if there is a lawsuit or if there is something that goes wrong, it's on you. And then, depending on what state you're buying in or what state you're doing a deal in, then they can come after your personal home. They can come after your assets. They can come after whatever other businesses you have. And they, meaning your debtors and creditors. So there's a lot more risk that comes along with making the better taxable return, and then also those fees. So, and then I think I explained that very simply. The fee that is consistent is the asset management fee, and it's only 2% of gross rents. So I've got some deals where that means like $425, like it's nothing, so and then you're doing a lot, like no matter how big the property is, you're all still doing the same things. You're still doing the marketing, the lead generation, the asset management, which is like tracking all your KPIs, checking your NOI, making sure that your current performance is on par with where you need to go for your exit returns. But anyway, point is that the GP, there's more liability. There's all the responsibility and all the work. Like I've had deals where I have like 8 insurance claims going on one right now. And I have tried to allocate it to my team and ask them to stand up and go, hey, go after this claim, go. But I don't know. I don't know what it is. Like there is a time period where you're doing your fiduciary duty and you're chasing after, say, insurance claims, or like I had to file a lawsuit myself the other week or whatever it is. And I know that we have the proof and we have all the information we need to win on the back end. So whether that looks like a check or whether that looks like whatever, like there's a period of time where you're fighting for things, you're not getting paid, so there's just a level of responsibility that you have to take on. For example, also monetarily too. So we had a property that construction wasn't moving as fast as it needed to, didn't get enough tenants in there as fast as we needed to, didn't have the income. So when you don't have income to pay your bills, guess who writes a personal check from their money to fund the business? You know what I mean? Imagine if you had, I don't know, 5 of those going on at the same time. Like that happens sometimes. And that has happened to me a couple of times. And so I have personally had to suffer to be able to do that. And that is the liability of the general partnership, to do the right thing and make sure that as much as we can to not have the limited partners receive a capital call, and to kind of eat it, so there's a lot that goes along with, making 2%, in a acquisition fee. So let's see, max rate loan to cost somewhere in here. There we go. So this itemizes this fee disclosure. So again, like you can see, and this is a team that's a little bit different. So very experienced team, like all together. It depends on if there's 3 of us right now. So one's got 10 years, I've got 6 years. The other one's got, she's got like 20 years or something. And then just depending on the fourth, who that looks like. But asset management fee market is 2 to 5%. Acquisition fee is 2 to 5%. Asset management fee is always 2%. And that's of the gross. Sponsored comp. So this is distributed net cash flow. And not in this slide, but in other slides, you can see like what happens. For example, if there is no net cash flow, this goes away. Like none of this happens. Equity investors. So basically they get paid before we do. So we do all the work. And the way that the waterfall of the cash works is that here 7 or 8% pref, depending on which share class you selected. And then an 80-20 split depending on. So like basically make some profit, you chop off 7%. That goes to these guys, 8% that goes to these guys. Okay, what's left? And then we split it 70% with these guys, 80% with these guys. And then whatever's left over, the general partnership gets. It's crazy. So so the investors, and we structure it in a way that they get quite a few benefits. So that's just kind of reality of it. And then so it's just kind of if it's about money, basically the way that it works is someone that puts in 200K on the GP side, and has a little sweat equity and is not the asset manager. Because like our property group, we're working to bring in a regional manager. We're working to bring in an asset manager and we have our project manager. So there's been so many deals where I've done all 3 and I wanted to die, because as the project gets bigger and bigger and bigger, it becomes impossible to keep up with multiple assets and all the different problems that each one could have. So you have to have a siloed discipline that deals with one area, or one lane, if you will. So anyway, so there's deals for sure like this one. I would not be getting an asset management fee. I would not be likely getting that sponsor comp. I would be getting a different percentage, because on this one, I'm not going to be the one being the lead investor and operating it, so, or I'm not going to be asset managing it because I don't live in Houston. That's another thing, is concentration. So yeah, if it's about returns, there's definitely ways that you can negotiate a better preferred return. There's ways, and again, it's usually in normal groups, it's normally has something to do with how much you invest. Some of it might have to do with the terms of what you invest. I think I mentioned earlier, there's ways that you can invest as a lender too. Like there are some other people that I've worked with that have large IRAs that they will lend out a portion of their money as a preferred investor, or as a preferred lender, or as a mezzanine lender. And so like a mezzanine lender, they're to get skin from me or us, what they want is our equity shares pledged. So we can pledge that, which is kind of like the last thing we want to do, but it's a possibility. And then a preferred equity provider, like we have medical doctors that do this a lot. They don't want to pay taxes on their IRAs by loaning it out, by being an LP on a limited partner on a debt leveraged asset. So they don't make any, they don't have that tax by just being a lender instead. And what's interesting is like a lender is a limited partner, but they're not called an LP. They're just someone who's smart. And those are the people that make the most money, is banks. The people that lend money, because they don't do any of the work and they can lend it in several places at once, and not have to take up all their time. So anyway, there's lots of ways to think about this, but it's really like, what are you making now? What do you want to make? And then time constraints. So what we wanted to do is like the next asset manager we take on. Really, I'm trying to groom Carolina, my partner. She's been with me for 3.5 years. I think that she'd make an excellent one, but it's taken me 1.5 years to get our standard processes together where I could hand it to her and say, hey, here's all the boo-boos that I made. And here's how to like set yourself up to where you have enough information and data and support where like that's not going to happen to you. And if it does, you know how to get out of it. But yeah, I mean, it's taken several years of us working together for her to earn that. And then I think something else that's important is having someone on the team that has a higher skill set than we do. You know what I mean? So for example, I don't have my CCIM. I wish I did. And I think that bringing on someone to the team that had their CCIM, that which is basically a master's in real estate investing and a master's in real estate finance, that person would be able to do a lot when it comes to acquisitions, dispositions, refinances, loan origination, just take care of certain parts of these deals instead of having, 5 people on the team kind of fumble all over each other and be like, who's doing what? Because it always ends up being one person that just does it all. And it's not where we're headed. So just take those things into consideration. So you always have to pick an instrument in the band. And right now acquisitions is really, really, really hard. And if you're really persuasive and don't mind creating relationships with brokers, like I finally got invited to my first skeet shooting event with the boys, because I was afraid to ask for it because I was like, well, they'll probably piss their wives off and like it's a boys thing because it's always other men, like that's it. And recently I just brought up like, man, I love shooting. I've been trained by police officers and I love doing that. And so someone else that I met was a broker that also did the same. And they're like, you should come. And I'm like, oh my God. So yeah, if you're good at building relationships, that's a way to get access to deals that we maybe currently don't have access to. So there's a couple of areas that we could use some partnership on. Yeah. And one thing I've done that I think is really important is reached out to those that have had incredible amounts of experience, like 10,000 units, 40,000 units, and tried to figure out like, what bridge did you have to jump off of so that you could create that scale? Like, what did it take? And just being able to glean a little bit of information from them, I think has been incredibly valuable to know where to focus. Where's my chat? Where's the chat? If anyone has any deals they want to pitch, if anyone has anything that they want to work together on, that's another thing that I want to bring up in the group, besides just blanketing you with information. So that we can work together and create wealth together. Sandra, did you ask, so what's going to happen? What does that mean?
You were talking about the Federal Reserve and you was giving us the links and saying, here you can go read about what's going to happen. And I was like, Kaylee, what's going to happen?
Yeah, I don't know. I really think, again, I don't have a crystal ball, but I think it's going to hike 2 more times this year. And then I think it's going to lock up. And then it's going to flip the other direction. I just don't know how long that'll even take. All right, Chelsea, see you soon. I'll see you next month. All right. So any other suggestions of what we want to cover in the months coming up? We want to make sure to get the right speakers lined up. Harita, I think you have a whole list that you wanted to cover. What are those? All right, Barb, I'm going to pick on you next too. Barb, what do you want to learn? I'm going to ask you to unmute. Brooke said, is there a beginner class? Brooke, what do you mean beginner class? You can unmute yourself. Feel free. Just hop in here.
Well, uh, since I don't know how to find brokers that will talk to me and just beginner classes. Where do I begin? There was a class I went to earlier today that had some kind of underwriter program, which might help, but it won't help unless I can find deals. So I need to know how to find them.
Yeah. Have you ever done like a personality test or anything like that?
I have been a sanguine before, but I've been through a lot, so I'm not sure I am anymore. But I don't know why.
Let me give you one. Burp, there you go. And let me know, and my email is Jane, like Jane Doe, JANE at apartmentqueeninvestments.com. Let me know once you take it, and I can tell you what your highest and best skill is, and then that would be a good place to start. When I got started, it was like, well, I guess I could capital raise, and like, I guess I could talk to brokers, and like, I don't know. Like, so what ended up coming out of that
Can
for me was I'm like the
Can you
highest.
put,
Yeah.
sorry, can you put your email in the chat or whatever it was that you just,
Yes, Jane at
Mhm.
apartmentqueeninvestments.com.
You were cutting out, sorry. Can you just put it in the chat or is that too difficult? Sorry. Thank you. Sorry about that.
You don't have to be sorry, but I do require spell check everywhere I go. So good luck. And I don't have the ability to have whatever it's called in here, the little green thing, Grammarly. So anyway, but yeah, so I would say know what your highest and best skill is. And then for me, it was persuader. So now it's come full circle where it's like, okay, you can use that in different ways in multifamily. So it's like, okay, am I going to persuade people to give me their best deals when I'm not like their biggest real estate investment trust client that has, 25 million bucks to spend tomorrow in a 1031? Or am I going to use my persuasive skills to raise capital or something else, So knowing like what your best is, like my cohort, Carolina, she's been with me 3.5 years. She does not want to be out there raising capital. She does not like being in front of people. She does not want to get herself out there. A million things I could say, but basically like what her highest and best is, her profile is the specialist. So for her, running numbers and being able to look for errors in data and being able to fix problems. Like we've had some issues on our properties, getting in there, having no emotions about it and just fixing it. Like that's her like highest and best. So whenever we run into tough stuff, it's like, okay, just call Carolina. She'll usually tell me it will be okay, So yeah, you'd want to know your highest and best and just email me when you know. And as far as courses, I mean, I don't really have any that we specifically have on like step-by-step what to do in multifamily. I only have my experience, and so for me, what that looked like, not that you asked, but what that looked like was being able to hook up with people in the industry that had a certain need in their life at the time and finding out how I could help them get to their next step. And some of the synchronicities are really interesting, but if you don't get to know the person, like you wouldn't know sometimes what they don't know they need, sometimes it's like, oh my God, like you have a huge gap, or like from the outside looking in, I see that like your spelling sucks on every blog post you put out there. I can help you with that. Like there's certain things that, the person could benefit from. So the first person I met in multifamily, theirs was getting rid of their lack of confidence of posting online about like how they're making a difference in the community, posting online about like their vacations and what they do, to use like credit card points to have this really cool lifestyle. Like they had a fear of like investors being like, well, I see you're doing all this, like you must be taking all the returns and embezzling money and like all this crazy stuff. And, that's obviously not the case. Or like when it came to his nonprofit, like kind of being embarrassed about what it was for. And anyway, then got more confidence, because I would do like a live video or I'd do stuff And then I'd send it to him and I'd be like, do one of these, or this, or I think you would do a really good job at doing this, and so he started trying. And now if you go look up Will Crozier, he's a DJ. He just got booked recently anyway, not that like I caused that to happen, you know what I mean? But like there was a point when I first met him that I was like, oh, this person's really like humble. That's great. But I was like, everyone needs to know like how cool of a person you are. So yeah, finding something that the person that you see maybe resembles yourself or is kind of similar to you, and being able to make it mutually beneficial for the both of you. That's what I did in the beginning. And that person was then willing to do things like I had someone that was willing to sign on a loan for me when I first got started. I've offered that to a lady that's in Houston recently, you know what I mean? I was like, I can do that for you if it's non-recourse. Like there's certain things that, you need in the beginning to get going, and you have to find those people, but you have to like cultivate a relationship, and it takes work and it takes time. So that's how I did it. And those people now, like I could call them any day and be like, ooh, hey, Will, I heard you are now taking solar energy from flares that are from refineries fracking oil in West Texas, and I own a property out there. Anyway, just like it's funny how it's a small world. So even when you build those relationships, they always come back. So that's how I did it. Not that anyone asked. Yeah, buddy. Barb, come on. Can you unmute and come on and tell us a little bit about yourself and what you want to accomplish and maybe questions you have? Harita, what topics do you want to cover? Are you interested in?
I don't have anything right now, Kaylee.
Didn't
But we will be doing the short-term rentals, right? Next week and next time,
maybe
in 2
we had a
weeks.
whole list. Do you remember those?
I think we can end this call, right? It's already late.
Yeah, that's fine. If you
9:12.
will, Harita, send me. When we got started doing this, we initially had a list of
Mhm.
of ideas, and I think we've already done a couple of them. So I would say let's add the short term to that one, and then rustle up, what we're gonna do, because the first is coming soon. And I think that next month Chelsea can be more of a support. So thank you all for getting on here. We appreciate it. Next month, maybe I'll try to do the Q&A before my market update. I think that might actually be smart because everyone's like super engaged, and then everyone kind of falls off. So next time we'll flip them so that you guys can get that Q&A out there. And we look forward to seeing you next month in April. And I hope that you remember when April Fool's is, because you need to play a joke on somebody, play a prank on somebody. But I look forward to seeing y'all next week. Thank you, Harita. Thank you, Chelsea.
Thank you.
First. And thank you everyone for joining. I'll see you soon.
Bye.
Adios.